So guys, now in this video, we are going to learn the computation of operating margin, that is in the case of taxpayer as also of the comparable entities. As we already discussed that what items which we are required to exclude from operating revenue computation and operating cost. When we are computing the operating cost, we need to exclude certain items. There are certain specific items as well and which are not related to the routine course of business. So that appropriately we need to exclude from both the operating revenue and operating cost, the specific items, and then after we need to arrive at the operating profit, which is operating revenue minus operating cost. Now I'll just share an example over here, which I have drawn up here. This is so this you may presume that this is from some entity's financial data which I have gathered. So in that particular profit and loss account, there will be also from apart from profit and loss account, there will be also notes to accounts under which the specific heads, the line items are under specific heads which have been displayed. Now appropriately, you need to identify such items which are of non-operating in nature, and then appropriately you need to exclude that from their respective. If there's an income, then you have to exclude that from your total revenue, and if it's an item pertaining to some cost, then you have to exclude that from the total expenses. How we do that? Now, if you see here, under profit and loss, there will be total revenue from operations and there would have been this other income reported. So under that profit loss, 33 crores, 33.92 crores would have been reported as total revenue, not profit loss. But now we have to go ahead and check the schedules of other income. And on checking the schedule of other income, we came to know that there is interest income, dividend income, revaluation of assets, and other non-operating income could be of miscellaneous nature or etc. Whatever income tax refund could be there. So such type of incomes were there which were credited to the profit and loss account. So that we are required to exclude that from this 33.92 crores. And appropriately we got this amount as 33.66 crores. So now that is what operating revenue is. Now we come to the expense portion. That in expense portion, first we noted down all the items of expenses in this particular field, that is cost of material consumed. So in this case, the party was engaged into manufacturing of some product, not in selling of some services, right? So in case of manufacturing of product, there was this cost of material consumed. Then there was this purchase of stock in trade. Then there were these changes in inventories which has been reported, employee benefit expenses, finance costs, and other expenses. So this is how this is how the reporting is done. So there could be also one more which is not included here, but there could be depreciation also, right? Some amount of depreciation also which could be reported here. So that is how you get the entire expenses from the financial statements. Now when you go ahead with that particular financial statements, there could be certain list of items which you are required to exclude from the uh, cost bucket. So what are this type of items? This could be provision. So as we saw that provision for uncertain liabilities, that is provision for bad debts. Then any income tax or interest on TDS or income tax paid. So that is already been excluded. Any other type of interest payment are also excluded. Then if there could have been loss of assets, then it could have been excluded. Then CSR or donation expenses, and then other expenses such as forex fluctuation on loan repayments and etc. This could be excluded. This needs to be excluded when you arrive at a not net operating expenses value, right? And appropriately, your operating profit will be your revenue minus, so operating revenue minus operating expenses. Now, I hope this clarifies to you that how the operating margin needs to be computed in case of taxpayers case when you are using the TNMM method. Now, this was in taxpayers case. Now, when you deal with comparables, so I have also listed down the comparable entities. So this entire chart will be made for every year. So because under TNMM, we are required to not only analyze a single year data, but we have to go to the prior 2 years as well. So in this case, our current year is FY 21-22, and appropriately, so we have captured here the data of pertaining to 22. Then prior 2 years, we need to check that if they were comparable or not. If they are comparable, we have to take that data also. So if you see this comparable name La Opala, then you can see here that I have captured this entire particular thing. So first of all, this is the presentation of computation with respect to taxpayers. So this is the taxpayers computation, presentation, computation of operating margin. and this is how you present the operating margin for the comparable entities, right? Now, if you see here, I have the under the both the files, the mechanism is same for computing of operating income and operating revenue, right? But what I have done here is I have, because this is a comparability analysis, so where I have to do this exercise for each and every comparable. So what I have done here is that I have placed here the common items in this particular B column, and appropriately under from each comparable I have fetched this data, and I have arrived at the net operating margin, right? Now, if this is on sales, then this operating profit which I have got here, operating margin which I have got here, that would be computed on operating revenue, right? So this is not on sales technically, this is on revenue, on cost, sorry. So this is computed on cost, right? So and this is operating profit. I'm sorry, I have this mistakenly written here. Yeah. So if you see this, if I am required to compute operating margin on cost, then the operating profit would be computed on this operating margin would be computed on the operating profit on the cost part, right? So this is where it comes 34%, and if this was on sales, then it would have been on net operating margin here, right? So this is how it needs to be computed. I'm sorry, again, this is why this is revenue only. This was revenue only. Sorry for that. Yeah. So this is how we need to compute the operating margin either on revenue or on cost. If this would have been on cost, then this would have been straight away like this way, 52%, right? So this is how we compute. That depends on the PLI which you take, which will be your next topic. Correct. So this is how you compute the operating margin for comparable entities. And for whatever relevant year you are required to capture data, you can capture data in this entire table, right? I'll be sharing this table also below this video, where you can access this entire file. I'm not sure if I'll be able to share this file, or probably I'll put that in our share drive, and then appropriately you can access the file from there. Right. Now, under TNMM, how you compute the weighted average is the same thing, that if you need to compute an average operating margin, that is weighted average operating margin on the revenue, then what you will do is you will first total out the operating profit figures of these 3 years, and then you will divide it by the total amount of revenue for this 3 years, and appropriately you will get this operating weighted average operating margin. So then after, you will go ahead and prepare your comparable data set. Let me just show you that data set also. So this is how you will draft this entire data set. Now, as we are discussing the data set also, now let me tell you that if I presume that there was a purchase transaction value of 4.5 crore in this particular case only, where the assessed operating margin was, operating margin operating cost was 6.88%, and no 6.44%, that is operating profit on operating revenues was 6.44%, while the arm's length margin is 12.542%. That is, from here we have obtained that value. Then the difference in percent was 5.98%, and appropriately the actual operating revenue is 33.38%, and the required differential margin would be 33.38 crores into 5.98%. So that would be the PP adjustment which would have to be made, right, under the purchase value. So you have to reduce the purchase amount by 1.99 crores, so that you can get the arm's length price of 2.51 crores. So this is how we arrive at arm's length price under TNMM. I hope this clarifies. I'll meet you in the second video when we are going to discuss the selection of PLI. I'll catch you in that video. Thank you.